133% in 1 year. One stock. 43% of an entire portfolio riding on a single name. This just happened, and most investors don't realize what it means yet. Here's what's really going on and what you should be thinking about right now. Because this isn't just a hot trade, this is a masterclass in conviction, straight from the playbook of the late Charlie Munger himself. A prominent protege of Charlie Munger made one of the boldest concentrated bets in recent memory. 43% of his entire portfolio, not a side position, not a satellite holding, went into a single stock. That's nearly half of everything, on one name. Right now, that bet is up 133% in just 12 months. To put that in perspective, a $1 million position became roughly $2.33 million in 1 year. Most diversified portfolios are struggling to beat the S&P 500's baseline return. This investor just more than doubled it by going the opposite direction, and the investment community is paying close attention right now. Retail investors are dissecting every filing, every interview, every signal this protege puts out. This echoes exactly what Munger preached his entire career, that real wealth isn't built by spreading bets thin. It's built by knowing something deeply, then having the guts to act on it at scale. Here's a number that should stop you cold. Munger once held more than 60% of his personal portfolio in a single stock for years. The math of conviction is not new, but most investors simply don't have the stomach for it. But here's what nobody is saying about this yet. Concentration risk cuts both ways. A 43% position that gains 133% is extraordinary. But a 43% position that drops 50%, that doesn't just hurt, it can permanently impair a portfolio. The same structural bet that created this headline could have wiped out nearly half of everything in a downturn. The mainstream coverage is celebrating the win. Nobody is doing the autopsy on what could have gone wrong. And that asymmetry in how we process these stories is exactly how retail investors get burned trying to replicate them. First, assess your actual conviction threshold. High conviction investing demands genuine research depth, not just enthusiasm for a narrative. Are you prepared to hold through a 40% drawdown? Second, understand position sizing mechanics. There is a meaningful difference between a 5% overweight and a 43% all-in allocation. Your risk tolerance, time horizon, and liquidity needs must inform that number before you ever make the trade. Third, study the process, not just the outcome. Survivorship bias is real. For every Munger protege up 133%, there are concentrated bets that went to zero. The educational value is in understanding why this investor had edge, not just that they won. 133% in 12 months. One stock, nearly half a portfolio. What do you think this means for your portfolio? Drop it below. This video is for educational purposes only, not financial advice. Always consult a qualified advisor.